Last year, millions of dollars in retirement income were overtaxed, not because seniors did anything wrong, but because they didn't know the rules had changed. Right now, thousands of retirees in California are unknowingly paying more to the IRS than they legally have to. And here's the shocking part. Many of them filed their taxes correctly based on outdated information. One small rule update, buried in federal tax adjustments, is quietly costing seniors hundreds, even thousands of dollars every year. If you're living on Social Security, a pension, or withdrawals from your retirement account, this directly affects you. A simple misunderstanding about required minimum distributions, tax thresholds, or income limits could trigger higher taxes, or even unexpected penalties. And once that money is gone, it's gone. In this video, we're breaking down exactly what this new IRS rule means for California seniors and why ignoring it could be a big financial mistake. Stay with me. Reason number 7 might surprise you. Number 1, it changes how your retirement income is taxed. One of the biggest surprises in this new IRS adjustment is how it affects retirement income calculations. Many California seniors assume that once they retire, their tax burden automatically drops. But that's not always true. In fact, depending on how you withdraw money from your retirement accounts, you could accidentally push yourself into a higher taxable range, even if your income hasn't dramatically increased. Here's where it gets tricky. The IRS looks at something called your combined income to determine how much of your Social Security benefits can be taxed. That includes your adjusted gross income, non-taxable interest, and half of your Social Security benefits. If that combined number crosses certain thresholds, suddenly up to 85% of your Social Security could become taxable. Many seniors don't see this coming because the thresholds haven't changed much over the years, even though living costs have skyrocketed. Imagine withdrawing a little extra from your IRA to help a grandchild or cover medical bills. It seems harmless, but that additional withdrawal could push your combined income just high enough to trigger more taxes on your Social Security, creating what experts call a tax torpedo. The result? You owe far more than expected. The practical takeaway is simple. Before taking large withdrawals, review how it affects your combined income. Consider spreading distributions across multiple years instead of taking one large lump sum. And always review last year's tax return to see where your income actually landed. These small adjustments in timing can protect thousands of dollars in retirement savings. And that's money you worked your whole life to build. If this is already opening your eyes, imagine what the next points will reveal. We put serious effort into breaking this down simply. So drop a comment below with the word check if you're reviewing your taxes this year. And if this helps you even a little, subscribe. It's just one click, but it helps us keep protecting seniors like you. Number 2, the RMD age rules have changed. For years, many retirees believed they had to start taking required minimum distributions, RMDs, at age 72. That used to be true, but recent IRS rule changes quietly pushed that starting age back, first to 73 and eventually to 75 for younger retirees. The problem? Not everyone knows which age applies to them, and confusion here can be very expensive. RMDs apply to traditional IRAs and most retirement accounts. Once you reach the required age, the IRS mandates that you withdraw a specific minimum amount every year. If you don't, the penalty used to be a shocking 50% of the amount you failed to withdraw. Even though the penalty has recently been reduced to 25% and possibly 10% if corrected quickly. That's still a painful hit to your retirement savings. Here's where many California seniors get caught off guard. Some delay withdrawals thinking they have more time. Others assume their financial institution will automatically calculate everything perfectly. But the responsibility ultimately falls on you. One missed deadline, especially the first one, which has special timing rules, can trigger penalties and unnecessary stress. Let's say you turned 73 this year, but didn't realize your first RMD was due. If you miss that withdrawal window, you may owe thousands in penalties before you even realize what happened. The smart move? Double check your birth year against the new RMD schedule. Mark your calendar well before the deadline. And consider speaking with a tax advisor to plan withdrawals strategically, especially if taking your RMD could push you into a higher tax bracket. A simple calendar reminder today could protect a significant portion of your retirement tomorrow. If this cleared up confusion for you, comment RMD below so we know you're staying informed. We spend hours researching these updates to protect your retirement. So please subscribe. It's just one click, but it helps us keep bringing you critical updates like this. Number 3. Penalties are lower now. Here's something most seniors have never been told. The IRS recently reduced one of the harshest retirement penalties in the tax code. In the past, if you missed a required minimum distribution, the penalty was a jaw-dropping 50% of the amount you failed to withdraw. Imagine forgetting to take out $10,000 and instantly owing $5,000 in penalties. It was devastating. Now, under updated rules, that penalty has been reduced to 25%, and in some cases it can drop to 10% if you correct the mistake quickly. That sounds like good news, and it is. But here's the catch. The IRS does not automatically forgive the penalty. You must take action, file the proper forms, and fix the error within a specific time frame. If you ignore it or delay, the higher penalty can still apply. And many California seniors assume that if they make a mistake, the system will notify them and guide them step by step. Unfortunately, that's not how it works. The IRS expects you to catch the mistake, withdraw the missing amount, and submit documentation explaining the error. Without that proactive step, you could still end up paying far more than necessary. The key lesson here is simple. Mistakes are fixable, but only if you move fast. Review your past distributions. Confirm that every required withdrawal was taken in full. If something was missed, correct it immediately and consult a qualified tax professional about filing for penalty relief. The difference between acting quickly and ignoring the issue could mean keeping thousands of dollars in your retirement account instead of handing it over in avoidable penalties. Or if you didn't know penalties were reduced, comment relief below so we know this helped you. We research and simplify these updates to protect your hard-earned savings. So please subscribe. It's just one click, but it keeps this information coming. Number 4. California doesn't always follow federal IRS rules. Here's where things get even more complicated. Many seniors assume that if they understand the federal IRS rule, they are completely covered. But California tax law doesn't always mirror federal tax law. And that gap is where costly mistakes quietly happen. For example, certain deductions, income treatments, or retirement adjustments allowed at the federal level may be handled differently on your California state return. You might calculate your federal taxable income one way, only to discover that California adds something back or limits a deduction. That difference can increase what you owe at the state level. Even if your federal taxes look perfectly fine, this becomes especially important when dealing with retirement distributions, pensions, part-time income, or investment gains. A withdrawal strategy that seems tax efficient federally could create unexpected state tax consequences. Many retirees only focus on the IRS portion and assume their tax software handles everything automatically. But software relies on the information you enter. And if something is misunderstood, the result can be inaccurate. Imagine thinking you're in the clear after filing federally, only to receive a notice from California months later requesting additional payment. It's stressful, confusing, and completely avoidable with proper awareness. The practical move here is simple. Always review both your federal and California returns side by side. Don't assume they match. If something looks different, ask why. And if you've recently adjusted your retirement income strategy, double check how it affects both systems. In understanding this federal versus state gap can protect you from surprises. And in retirement, peace of mind is just as valuable as savings. If you've ever been surprised by a state tax bill, comment state below. We read every single one. We put serious time into breaking this down clearly for you, so please subscribe. It's just one click, but it helps us continue protecting your retirement. Number 5. The standard deduction has increased. At first glance, the higher standard deduction sounds like great news. The IRS adjusts it regularly for inflation, which means many seniors can shield more of their income from taxes without itemizing deductions. For retirees living on fixed incomes, that feels like a welcome break. But here's what most people don't realize. A larger deduction doesn't always equal a lower tax bill. Why? Because what really matters is your taxable income after all calculations, and how that income interacts with Social Security taxation, Medicare premiums, and retirement withdrawals. Sometimes, relying automatically on the standard deduction can cause you to overlook itemized deductions that might reduce your taxable income even further. For example, if you had significant medical expenses, property taxes, or charitable contributions, itemizing could potentially provide a larger total deduction than the standard option. Many seniors skip this comparison because they assume the higher standard deduction makes the decision simple. But even a small difference in taxable income can affect your tax bracket or how much of your Social Security becomes taxable. Imagine reducing your taxable income just enough to stay below a critical threshold. That small shift could mean paying less not only in federal taxes but possibly lowering the ripple effect on other financial areas. The key takeaway is this: don't assume, compare. Each year, run the numbers both ways if possible. Review whether itemizing might actually serve you better. And if your financial situation changed, such as increased medical costs or charitable giving, take a second look. A few minutes of comparison could mean keeping more of your retirement income exactly where it belongs, in your pocket. If you're going to double check your deductions this year, comment deduction below. We work hard to simplify these tax updates for you, so please subscribe. It's just one click, but it keeps valuable information like this coming your way. Number 6. Qualified charitable distributions, QCDs, can lower your taxes. Here's a strategy that many California seniors either overlook or misunderstand. Qualified charitable distributions, often called QCDs. If you're age 70 and a half or older, the IRS allows you to donate directly from your IRA to a qualified charity, and that amount can count toward your required minimum distribution without being included in your taxable income. That's powerful. Why does this matter? Because normally, when you take money out of a traditional IRA, it increases your taxable income. And as we discussed earlier, higher income can trigger more taxes on your Social Security and even increase your Medicare premiums. But a properly executed QCD bypasses your taxable income altogether. Then that means you're fulfilling your RMD while potentially lowering your overall tax exposure. Here's where timing becomes critical. The funds must go directly from your IRA custodian to the charity. If you withdraw the money yourself first and then write a check, it may not qualify. That small procedural mistake could cost you the very tax benefit you were trying to secure. Imagine supporting a cause you care about while also reducing your tax burden. It's a win-win, but only if done correctly and within the annual limits set by the IRS. The smart approach is to plan charitable giving before year end. Confirm that the transfer is processed properly and keep documentation for your records. Even if you take the standard deduction, a QCD can still provide tax advantages because it reduces your adjusted gross income directly. When used strategically, this rule can quietly protect thousands of dollars over time. If you've ever donated from your retirement account or plan to, comment "Give Smart" below. We put real effort into breaking down strategies like this, so please subscribe. It's one simple click, but it helps us keep protecting your hard-earned savings. Number 7. The tax torpedo can quietly hit your Social Security. This is the one that surprises almost everyone. It's called the tax torpedo, and it can quietly cause your tax bill to spike even if your income only increases slightly. Here's how it works. When you withdraw money from a traditional IRA or 401k, that withdrawal increases your adjusted gross income. But it doesn't stop there. That higher income can also cause a larger portion of your Social Security benefits to become taxable. In some cases, up to 85% of your benefits can be included in your taxable income once you cross certain thresholds. The shocking part? Those thresholds haven't been significantly adjusted for inflation in decades. So as retirement account balances grow and cost of living adjustments increase Social Security payments, more seniors are unknowingly pushed into higher taxable territory. Imagine this scenario. You withdraw an extra $5,000 to cover home repairs. That withdrawal increases your income, but it also triggers additional taxation on your Social Security. The end result might feel like you're being taxed on much more than $5,000. That's the torpedo effect, a chain reaction that catches retirees off guard. The practical strategy here is careful withdrawal planning. Instead of large, unpredictable distributions, consider spreading withdrawals strategically over multiple years. Some retirees even look into Roth conversions earlier in retirement to reduce future taxable income. The key is awareness. Once you understand how this ripple effect works, you can plan around it instead of being blindsided by it. If this is the first time you've heard of the tax torpedo, comment torpedo below so we know this reached you. We spend hours simplifying complex rules like this, so please subscribe. It's just one click, but it helps us keep protecting your retirement income. Number 8. Your taxable income can increase your Medicare premiums. Here's something that catches many California seniors completely off guard. Your tax return doesn't just determine how much you pay the IRS, it can also determine how much you pay for Medicare. This is because of something called IRMA, which stands for Income Related Monthly Adjustment Amount. In simple terms, if your income crosses certain thresholds, your Medicare Part B and Part D premiums can increase, sometimes significantly. And here's the twist: Medicare uses your tax return from 2 years ago to calculate those premiums. So a large retirement withdrawal today could raise your Medicare costs down the road, even if your income later drops. Imagine selling investments, taking a large IRA withdrawal, or receiving a one-time payout. It feels like a single financial event. But that one decision could push you over an income threshold and trigger higher Medicare premiums for an entire year. What makes this especially frustrating is that many seniors don't realize the connection until they receive a notice showing increased premiums. By then, the decision that caused it is already in the past. The smart move? Before making large withdrawals, check how close you are to the next IRMA threshold. Even keeping your income just a few dollars below a cutoff could save you hundreds or even thousands in Medicare costs annually. Retirement planning isn't just about taxes. It's about understanding how every financial move creates ripple effects across your entire income picture. If you didn't realize your taxes could affect your Medicare premiums, comment Medicare below. We put serious time into researching these hidden connections, so please subscribe. It's one simple click, but it helps us continue bringing you critical updates like this. Number 9. New reporting rules could increase audit risk. Many seniors believe audits only happen to business owners or high-income earners. But recent IRS reporting updates are widening the net, and retirees are not automatically exempt. In fact, certain types of retirement income, side earnings, or investment transactions now generate more detailed reporting than ever before. For example, brokerage firms issue detailed 1099 forms that report investment sales, dividends, and capital gains directly to the IRS. Digital payment platforms and certain side income sources may also generate tax documents if you cross reporting thresholds. The IRS computer systems automatically match what was reported to them against what appears on your return. If something doesn't line up, even by mistake, it can trigger a notice. Here's the problem: many retirees forget about small transactions. Maybe you sold a few shares of stock. Maybe you did occasional consulting. Maybe you moved money between accounts and misunderstood how it would be reported. These small, innocent oversights can create discrepancies. An audit doesn't always mean wrongdoing. Often, it's just a request for clarification. But responding takes time, documentation, and energy, something most retirees would rather avoid. The smart approach is organization. Keep every tax document you receive. Don't rely on memory. Before filing, cross-check that each 1099 or income statement is reflected correctly on your return. If you changed financial institutions or had unusual transactions during the year, review them carefully. The goal isn't fear, it's preparation. The IRS uses automated systems, and automation doesn't overlook mismatches. Staying organized is your best defense against unnecessary stress. If you promise to double check every 1099 this year, comment ready below. We put hours into researching updates that protect you. So please subscribe. It's just one click, but it keeps this valuable information coming. Number 10. Estate and inheritance rules are changing. This final point is one of the most overlooked, yet potentially the most expensive. Recent IRS adjustments and existing federal laws have changed how inherited retirement accounts are handled. Many seniors still believe their children can stretch inherited IRAs over their lifetime. In most cases today, that's no longer true. Under updated rules, many non spouse beneficiaries must now withdraw the full balance of an inherited IRA within 10 years. That might not sound urgent at first, but imagine your child inheriting a large retirement account during their peak earning years. If they're required to withdraw the funds within a decade, those distributions could push them into much higher tax brackets, shrinking the inheritance you worked so hard to build. Here's where planning becomes powerful. Some retirees explore strategies like partial Roth conversions during lower income years. Others review beneficiary designations carefully to ensure accounts are structured efficiently. Even something as simple as updating outdated paperwork can prevent major complications later. Another key factor is the step up in basis rule for taxable investment accounts. Assets held in brokerage accounts may receive a step up in cost basis upon death, potentially reducing capital gains taxes for heirs. But retirement accounts do not receive the same treatment. The takeaway is simple but critical. Estate planning isn't just for the wealthy. It's for anyone who wants to protect their family from unnecessary tax burdens. Reviewing your account types, beneficiary forms, D and long-term withdrawal strategy today could save your loved ones significant stress and money tomorrow. If protecting your family matters to you, comment family first below. We dedicate real time and effort to simplifying complex rules like this. So please subscribe. It's just one click, but it helps us keep guiding and protecting families like yours. If there's one thing to take away from this video, it's this. Small tax decisions can create massive ripple effects in retirement. From required minimum distributions to Medicare premiums, from Social Security taxation to inheritance rules. Everything is connected. And unfortunately, many California seniors only discover these connections after they've already paid the price. The truth is, the IRS doesn't send warnings ahead of time saying, this withdrawal will increase your Medicare premiums, or this extra income will trigger higher Social Security taxes. The system simply calculates the numbers, and the consequences show up later. That's why awareness is your greatest financial defense. But here's the empowering part. Once you understand these rules, you gain control. You can time withdrawals strategically, and you can compare deductions properly. You can plan charitable giving wisely. You can structure your estate to protect your family. These aren't complicated tricks. They're informed decisions. Retirement isn't just about saving money. It's about protecting what you've already earned. And in a state like California, where living costs are already high, every dollar matters. So don't ignore these updates. Review your last tax return. Look at your income thresholds. Ask questions. Even a short conversation with a qualified professional could uncover opportunities you didn't realize were there. Staying informed today could mean thousands of dollars saved tomorrow and far less stress in the years ahead.